Ooh, as a good friend of mine would say, now we are cooking with gas. The rolling crash on the stock market has further deepened oversold market conditions. Before I get into that, let's snapshot the time on this. We are Friday, April 4th. This is Yahoo Finance homepage. It gives me a great view of what has troubled the market. So here you see the graphic that will be permanently burned into people's minds, tariffs announced, and we just have been rolling downhill for the last 2 days since. And you can see the market, as I mentioned in an earlier blog, the market has just surprised me in how misguided and over optimistic it has been dealing with the possibilities of what's to come. And you could see how the market rallied. I believe this is the S&P 500. Oh yeah, all three of the major indices. They all were rallying as if there was good news to be had. So that, of course, because there was all that optimism ahead of time, that further deepens the disappointment and the further panic. So here we go. Worst weekly meltdown since 2020. That, of course, was the pandemic year. We have Here's the snapshot of all the markets here. Even gold was down. And before I forget later, let me just say that I even sold my gold. I've been a gold bug. I've held gold for a very long time. When I get to the chart, I'll explain to you my thinking. So anyway, enough of the headlines. Let's just jump right into the charts. Here is cooking with gas. Um, my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I call AT50 for above the 50, plunged. This is record plunge territory. I don't think I can find, it'll take me a while to find a day like this. We plunged all the way 10 percentage points to 9.2 to give you, we are deep, deep oversold territory. Just to give you it's going to look a little messy. I apologize for that. Let's first go to regular. Just show you how rare it is to get to single digit level, right? So of course we got to I don't think we ever hit single digits since the pandemic. Yeah, I don't think so. Yeah, I don't think we did. Anyway, the pandemic we did back in 2019 when we had a big sudden market correction. I think we got to single digits. Anyway, point made. This is very rare. And since we're here, let's also take a look at the equivalent for the 200-day moving average, which is the percentage of stocks trading above their 200-day moving averages, which I call AT20, AT200. As I've been warning constantly about worst case scenarios, I could see the path for this important measure of long-term health of the market slipping right past the low from 2023 and testing the 2022 lows. That is exactly what has now unfolded. I am not ready to contemplate it getting even lower. It actually, because this is a 200-day moving average, it's actually extremely hard for it to get even lower than this. But you can see here it is possible, like during the pandemic and again during 2018, 2019. So that's the overall context. Let's take a quick look at the indices, and I do want to spend some time on individual stocks. So what is a rolling crash? Well, a rolling crash looks like this. It's even hard to see what happened today. The S&P 500 actually dropped 6%. It dropped 10% total in just 2 days. Now, the conventional definition of a correction is 10% just off the all-time highs. And yes, the S&P 500 made it in just 2 days. And what I didn't even think was on the table anytime soon is now on the table, which is a conventionally defined bear market of 20% off the all-time high. I've been calling this a bear market ever since the S&P 500 dropped below the 200-day moving average, and I thought we got relief here when it got back above. This whole episode, this whole time period is a great reminder of why having a faster signal for a bear market is very helpful. And I actually honestly wish that I had followed my own signals more rigorously instead of looking for the reasons to look for bounces. I should have been looking for the reasons why this bear market could get worse, because that's exactly what happened. Another thing that I warned about could happen, it was even worse than I could have imagined. So the NASDAQ opened market trading today at the conventional definition of a bear market, which is 20% off all-time highs, and it just continued to slip from there. It also lost 5.8% on the day. where in the world did it even stop? So now we are all the way back to, um, we're almost at 52-week lows, not quite. But this is actually also represents just how good we've had it for so long in terms of just the constant push higher. I mean, the NASDAQ is well below bear market territory, and yet it's not even at a 52-week low yet. So I'm not even going to contemplate from this point how much lower we can go. At this point, it's just like throwing darts. Anything could happen. So we just have to be braced. And of course, the small caps, I've said enough about them in previous posts and videos. Small caps also plunged 4.7%. That takes us to all the way back to November of 2023. So yes, lots of ugliness. The VIX. Now we're going to get into my trading rules. The VIX, very scary. It closed near at the highs of the day. I went ahead and added another put option on VXX, which is fading volatility. I'm afraid that that position is just going to blow up by Monday. If peace doesn't break out over the weekend, I'm expecting and bracing for a big gap down on Monday if nothing else changes. And this is exactly the behavior I did not want to see in the VIX, which is just a constant push higher all day, a close near the highs. It means that the VIX is primed to go even higher. What I wanted to see was a fade from the highs. And now, since it instead went all the way to the high, I want to see a quick implosion, a quick volatility implosion on Monday, but I just don't think we're going to get it. Okay, let me jump into charts. I'm going to go really quickly here. Pardon if I'm looking away a lot because I have this list that I want to refer to. I talked about Avis Budget Group car. I was fortunate to get out of my position near the lows. I don't know why it rebounded so hard off the lows. I still think that trades like this are ones to be faded. The car, if everything we know now stays the same, I don't think there's any way to hide out in dealers of used cars. Okay. So materials, rare earths, MP materials. This is actually a stock that just now is breaking down. And it was on my buy list, but now I'm wary because it finally put in this bearish engulfing pattern and it's broken down below the 50-day moving average. So I'm on alert. Here's a positive. I posted on this on social media. Nike, it triggered an alert for me that was set to Nike being up 3%. I chased it. I bought some shares and call option. Let's see if that actually holds out. Caterpillar, I keep looking at this. I chased it down yesterday to get a hedge in, and my hedge was totally mispositioned. I had bought a calendar spread at the 300 strike. I felt fortunate just to get out of this with a profit, small profit. And it's always a terrible feeling when you predict the right direction, not predict, but when your position is correct in direction, but not in configuration. And that's what happened. If I had just bought a put spread even, I would have been so much better off. But I was being quote unquote cheap, and that's what I get. This is another one that I forgot to look as a hedge, which is FXI, the iShares China Large Cap ETF. Notice it is broken down below its 50-day moving average. It fell 7%. And of course, that's because of what's ironic is that it's fallen now a lot more after China retaliated to the US tariffs. You would have thought that FXI would have fallen on US tariffs. So I'm sure there are a lot of people who got fooled by FXI holding at the 50-day moving average support and thinking everything is just fine. No, it's not fine. Okta is a stock that I have been bullish on. It unfortunately has completely collapsed. I had a lingering call option in this and but it's actually going to be on my buy list because this is the kind of stock that gets thrown with the bathwater where people just completely forget about the great news that just happened a month ago. So hopefully, I can buy it at the 200-day support and I can move from there. Okay, let's take a look at PVH because it had a big pop on earnings and look at that. Thanks to the tariff announcement, it practically reversed all of those gains. It dropped 15%. PVH is a retailer. Oracle, this is a stock that I was bullish on. It's completely broken down. Even looks like it could be a sort of head and shoulders move here. And you can see it further collapsed today at 6.5% and is back to the summer lows. Okay, let's see, Twilio. I've written a lot about this. I lamented missing out on this breakout. Now I'm glad I'm not even in it. Twilio has just been breaking down. I think there was a rumor yesterday that it suffered a breach, but now it's finally closed below its 200-day moving average, so it's in bearish territory. Now it's looking like this big excitement back here was just one big fat bubble. I mean, the stock has almost collapsed 50, maybe 40% off of its recent all-time high. These are the kinds of charts when you look at them, you're like, well, what was the excitement all about in the first place? And these are the kind of charts actually to be wary of. So whereas Okta still is in good position to buy because it's above the 200-day moving average and one of the few stocks left, of course, a stock like this, once it's broken down below the 200-day moving average, kind of changes the whole game. Okay, Apple, terrifying here, but I went ahead, held my nose. I went ahead and bought a call option. I talked about this before, how I stared and stared at Apple yesterday, but I just couldn't pull the trigger. I won't go through my explanations again, but I mean, down another 7%. So it was down, what, 9% yesterday, down 7% today. I just had to pull the trigger for a short-term trade. My call spread expires at the on Friday, so let's see if that gives it enough time to bounce some way, somehow. And despite this crash in Apple, look, it's only back to, it's also not at a 52-week low yet. But I think the October 2022 low is beckoning if, there is more selling follow through to be had. Okay, Best Buy is another one I couldn't resist. I showed it yesterday. Oh, sorry, I wrote about it yesterday. It was down as much as 5% today, I think, and I couldn't help it. This is near the pandemic lows. I sold a put. I know everything looks terrible for retail right now, but these are just such extreme moves. The trading rules dictate that I act. Hack, there are some ETFs that I'm in. I'm in Hack. I was hoping it could hold 200-day moving average. Of course, it didn't. Now it's in collapse mode. This is one that will be on my list to add to at some point soon. ETFs are the best way to go for at least for my trading strategy. Again, I'm only showing this thing for informational purposes, so make your own decisions according to your risk tolerances and time horizon for investing and trading. But for me, I like starting to buy stuff um, in the oversold conditions with ETFs because I don't have to worry about company specific idiosyncrasies and news, which can completely destroy the oversold setup. So Hack is on my list. It's one of those ETFs that's on my list. I didn't buy any more this week. IPO I did add to today. IPO Renaissance ETF. It plunged another 7%. Takes it all the way back to November 2023. This is, of course, a much more speculative name, so I think the recovery is going to be very slow for anything that's speculative like IPO. And then another one, of course, is ARK. I did dare to add to ARK. I consider ARK very speculative, and I recognize it's very damaged goods for many reasons. It is only back to last September's low, but you can see now it's left behind what's looking kind of like a bubble of enthusiasm for ARK. And just as a reminder, even though I'm really skeptical of the investing approach that goes into ARK, what I'm doing is I think there's still a chance that Kathy Wood and company can turn this thing around, and I just want to have a small piece of it if indeed it does take off once again. And of course, if you really want to get speculative, what taking off looks like is something like this. It'll never go this high this fast, but I think over the years, I think it could eventually get to somewhere maybe halfway up there. So that's what I'm trying not to miss out. Hopefully, I don't get burned trying to play that. Now, I also want to, oh, right, gold. So let me explain why I got rid of gold. I've been such a bull of gold for since like 2008, 2009 or something. So I am not bearish gold, but I just didn't like the way gold gapped down yesterday. Because when something doesn't act the way I need it to act and doesn't act the way in which I expect it to act for the reasons I bought it, then I have to really question it. And in this case, I just had to question what is going on? Why isn't gold soaring after that tariff announcement? So I got out of my position, my core position. I still have a call spread. I'm not optimistic about it because sure enough, today sellers followed through 2.3%. If gold sells off sharply, as I always do, I will buy. But at these levels, I think there's something wrong. I don't quite understand it, but I don't want to stand in the way of it. So that's my explanation on gold. I also, believe it or not, even though I always say don't panic, don't sell into a sell-off, there actually, and I'll have to write about this so I can be very clear about my approach here. There are some stocks, and actually I did mention this, I think, in a video last week, which is in some moments of deep selling, there actually can be reasons to dump stocks overboard. And what I did today, I came in today with a list of my weakest stocks, the ones that I really am totally tired of, and I just want to get rid of them and preserve the cash for much better investments. I was hoping for some sort of rebound today. I didn't get it, but I still stuck to my guns and sold most of those weak stocks. And my rationale is that the stocks that were weak going into this mess are going to be have a very hard time recovering whenever the oversold bounce comes. So why not take that, take the loss finally, overdue loss, and move that cash to other opportunities as they present themselves. So this is one I tried to stick with Informatica. I was very bullish. I thought it was going to get taken out by a bigger software firm like Salesforce. Didn't happen. And I've just gotten tired of hanging around and waiting in it. I sold it. I'm going to repurpose the cash to some other better opportunity. And these are what I call no regret sells. I'm going to write an article about this. I call it no regret because based on the information I have now and the strategy that I have in place now, this decision makes complete 100% sense to me. It doesn't matter what Informatica does in the future. I might decide to get back in if conditions improve, but this decision's quality is not dependent upon what Informatica does going forward. What matters now is what information I had at the time I made this decision. And this no regret sale applies to a few other stocks that I sold into the middle of the sell-off because I think they're just damaged goods and in the worst case scenario, these are companies that may not even survive the current economic chaos. Okay, I think I've covered all the stocks. Oh no, let's do two more. Sorry, one more. Celestica, it confirmed a 200-day moving average breakdown. This is staying on my buy list. I love Celestica as a contract manufacturing company. The thing is, I don't know where all their factories are and how tariffs will impact them. So that's something to be careful of. But I do hope to be a buyer above the 200-day moving average. Okay, well, that's it for today. I know whirlwind round of stock charts. If you have any questions or feedback, put them down below. Otherwise, like, share this comment. Help me get the algorithm to recognize that this content is worthy of attention. Follow me on YouTube. You can also check me out on my blog at drduru.com/122, all letters. I will check you out the next time. Be safe out there. Be careful. Be soberly minded. And just remember, we are in unprecedented territory, economic times. Past patterns are likely not to be um, good templates for what's to come. I'm trying to stick to my AT50 trading rules because I think those are still solid. They're high level enough that it should apply to any extreme. But of course, as the macro continues to get worse, extremes, oversold could get yet more extreme. But today's extreme was just in the single digits, um, just, mind-boggling. I'll just leave it at that and see you the next time. Take it easy. Again, be careful out there.